Now, moving forward with the fundamental analysis, first we'll talk about the expected return, for which we have used the capital asset pricing model. What's mean of capital asset pricing model? The capital asset pricing model provides link between the returns and non-diversifiable risk. By using capital asset pricing model, which is also known as CAPM, the investor assesses the extent of additional return or risk-free return for given level of risk. So, if CAPM return is less than expected return, then one should buy that share. If CAPM return is greater than expected return, one should sell the share. And if CAPM return is exactly equal to the expected return, then one should hold its position. There is a formula for calculation of expected return through CAPM model. This is RF plus beta times of market risk premium, wherein RS is expected return of stock, RF is risk-free rate, the beta is the beta of the stock, and the market risk premium. We just discussed this thing in a earlier slide. So the expected return of the CAPM formula is used to discount the expected dividends and the capital appreciation of the stock over the expected holding period. So if the discounted value of those future cash flow is equal to the current market price of the share, then CA formula indicates that the stock is fairly valued. There are some problems with CAPM. The modern financial theory rests on two assumptions. First, the security markets are very competitive and efficient, and the second, these markets are dominated by rational risk-averse investor who seeks to maximize satisfaction from return on their investment. Despite these issues, the CAPM formula is still widely used because it is simple and allows for easy comparison of investment alternatives. The CAPM assumes that the risk-free rate will remain constant over the discounting period, which is not true. The market portfolio that is used to find the market risk premium is only a theoretical value and is not an asset that can be purchased or invested. The most serious critique of CAPM model is that the assumption that the future cash flow can be estimated for discounting process. As we have seen the formula for calculation of expected return through CAPM module, here the brief or the description of how we have calculated. So one thing I would like to discuss that the market return has been taken from 11 November 2016 to 20th February 2020. Because of the Black Swan event, which is also known as COVID-19, I have ignored the market result after 20th February. Let's move forward with dividend discount model. There are various models in which we can calculate dividend discount. There are Miller model, there are Walter model, there are Gordon model. I have used Gordon model. The Gordon model suggests that market price of the share is present value of future dividends. But there are assumptions for basis of this Gordon model. The assumptions of the Gordon models are: the firm is an all equity firm, means only the retained earnings are used to finance this. Then the rate of return and cost of capital become constant. The life of firm is indefinite. Retention ratio once decided remains constant, which is not true. Growth rate is constant, which is also not true. And the cost of capital is greater than BR. What are the criticisms of a Gordon model? It is assumed that The firm's investment opportunity is financed only through retained earnings and no external financing. Thus, the investment policy or the dividend policy both can be suboptimal. And second one, the Gordon model is only applicable to equity firms. That the rate of return is constant, but however it decreases with more and more investment. It is also assumed that the cost of capital remains constant, but it is not realistic because in a real life it ignores the business risk which has direct impact on firms' values. Thus, the Gordon model posits that dividend plays an important role in determining share price of the firm. How we have calculated the formula by using the Gordon's growth model is given here with. The price per share is D1 divided by R minus G, where D1 is dividend at end of year 1, R is rate of return, and G is growth rate. So on basis of that we have calculated return on equity, which comes 30.05. Then the growth rate is BR, and DPR is a dividend payout ratio, which is as per books of account, which comes 56.60%. Accordingly, we have calculated the price per share, price per dividend. Another method is discounted cash flow method. Discounted cash flow method is a valuation method used to get the value of an investment based on its expected future cash flow. So what it figures out is the value of the investment today based on projections of how much money it will generate in the future. The key aspect of the discounted cash flow method, which is also known as DCF, which helps in determining the value of an investment based on its future cash flow. The present value of expected future cash flow is arrived by using a discount rate to calculate discounted cash flow. If discounted cash flow is above the current cost of investment, the opportunity could result in positive returns. Companies typically use the weighted average cost of capital for discount rate, as it takes into consideration the rate of return expected by shareholders. Also, the DCF has a limitation that it relies on the estimation on future cash flow, which could prove inaccurate. The formula for determining cash flow is given in this slide, wherein DCF is equal to CF1 divided by 1 plus R plus CF2 raised to 2 divided by 1 plus R plus CFN raised to N divided by 1 plus R, where N is the number of years or number of period. CF1 is for 1 year, CF2 for 2 years, R is a discount rate. Under this method, the projected free cash flow to the firm are discounted at weighted average cost of capital. The sum of discounted cash flow of such free cash flow is the value of the firm. Where we can use the DCF method? It used in estimating future cash flow. Then appropriate discount rate to be applied to the cash flow, that is cost of capital. Estimation of the terminal value of the free cash flow subsequent to discrete projection period by taking into consideration full investment cycle of the company. Under DCF method, the value of business is the function of projected revenue and earning generated by asset, then the expected economic life of the asset, the contributory asset charges that would be paid to the requisite operating assets, and a discount rate which reflects risk associated with receiving future cash flow. The particulars and the amount which we can see in this current slide is of Pharma Nutra company for the year ended 2019. On basis of that discounted cash flow method, we have on basis of that we comes to the calculation of per share value, that CF11 is taken 2020, CF2 2021, CF3 2022, CF4 2023 and CF5 2024. So from 2020 to 2024 all are the projected figures which may not be accurate, because again we have to consider COVID-19's impact. So on basis of that we comes cost of equity, then the growth rate, the terminal value at the capitalized in 2024, free cash flow available for equity. So the period, the 2020 is considered 1, 2021 2, so accordingly 2024 5. We have taken PV factor also, which we know how to calculate. Then the present value of the cash flow as per the method. So we comes at the present value of the terminal value, at then the total value of the firm, wherein we add cash and bank balance, then we comes at the total value of the firm. So considering the current number of ordinary shares, which we can divide and we get the per share value. This is as per DCF method. Last thing of this, the comparison analysis with market multiples. Comparison analysis is a process to evaluate the value of the company using matrices of metrics of the other business of similar size in the same industry. Comparable company analysis operates under the assumption that similar companies will have similar valuation multiples. So analysts compile a list of available statistics for the companies being reviewed and calculate the valuation multiples in order to compare them. Comparable company analysis start with establishing peer group consisting of the similar companies of similar size in the same industry or a region, which is not the case that we will get the similar companies with the similar size and the same industry. So for doing comparison analysis, I have taken Sanofi and Record T, these two companies. For comparison analysis, there should be adjustment with regard to size, liquidity, margin difference and leverage structure. The comparable company analysis is the process of comparing companies based on similar matrices to determine their enterprises value. The most common valuation measures used in comparable analysis are enterprises value to sales, EV to sales, EV to S, then price to earning, PE, then price to book, PB, and price to sales, PS. So on basis of that, we can see here the figures are for the year 2019. So MCAP, revenue, operating profit, profit after tax, borrowing, cash and cash equivalent and enterprises value. So on basis of this, we comes at the various multiples, PE multiples, in EV/EBIT, then market cap to sales. So we can see the difference in a P multiple of Pharma Nutra comes 32.29, whereas Sanofi 37.97, where Record T 25.22. So same in case of EV/EBIT multiple also. The difference in multiple is due to the different size, the products offering, the margin, the capital structure and future growth opportunities available to each of these companies. Let's move with the capital structure. The company's capital structure is consist of equity as well as the borrowed capital. The share capital which we have seen that it amounts to 1123,000 euros, and then the borrowed capital also. So the total equity and borrowed capital goes 2666 equity capital, which is at end of the year 2019, is approximately 2666,000 euros. The comparison between equity and borrowed capital has been given here. The equity is same, as you can see in 2018-2019 nothing has been increased, but borrowed capital increased from 1543,000 euros till 1831,000 euros. Though the company had showing the debt at the end of 2019 amounting to $5.62 million, which has been up from 5.34 million euro. Though it has debt, it do have 18.8 million euro as a cash offsetting, leading to the net cash of 13.2 million. So the company is a very cash rich company, and the investor should not bother with the borrowed amounts by the company. Below of this there is a historical debt chart, which you can see the debt is very minimum or maintaining its level, but the cash and net worth is growing up, which is very good sign that company manage its debt safely. Now the credit rating, mainly there are three agencies in Italy that provide credit ratings: Moody's, Standard and Poor's, also known as S&P's, and Fitch Rating. Each of these agencies helps by giving rating to the companies, which also helps the investor to determine the risk associated with investing in a specific company. The current Italy credit ratings according to the main rating agencies have been given below. As per Fitch Rating, the healthcare sector comes under the medium risk category. As company got its traded admitted in month of July 2017, company has not yet received credit rating from any of these agencies. In next slide and below of this wording, you can see there are no records. Fitch, there are no records for no in a Fitch Rating there is a no credit rating for the pharma. In S&P also there is no record, and Moody's rating, and also DBRS. There are no credit rating has been given by any of these credit rating agency to the Pharma Nutra. Let's move to the dividend policy. As we have seen, the ownership structure in Italy is highly concentrated. As in case of Pharma Nutra, most of the equity shares are hold around 65% of the share total issued shares holds by Lacote brothers, the founder members of this company. So as on date, the Pharma Nutra company do not have any specific dividend distribution policy. Dividend made by Pharma Nutra, it's out of their annual profits and normally on interim or annual basis. From date of its admitting for trading, the company is distributing the dividends. The details of dividend which has been declared by the company since it got admitted to the trading is given here. The first was declared May 7, 2018 was 0.33, then May 6, 0.5, then May 6, 2019, 0.5, then May 11, 2020 was 0.46. You can see here all are ordinary shares, and we can see the payment also. Though this black swan event COVID-19 came in month of March. Company has declared dividend in May 11, which the payment also has been done, which can show the positiveness of the company, which can attract investors. So how company covers its dividends? Company covers its dividend by both profits as well as cash flow, which is sign that dividend is sustainable, and lower payout ratio usually suggests a greater margin of safety. So Pharma payout ratio is modest at 50% of profit, but it uses 68% of its cash flow, which is also within average range of the most of the companies. The annual increase rate is 80% in its dividend based on past 2 years of dividend payments, and it will be great to see the earning per share growing rapidly over several years and dividend per share growing right along with it. So in my view, it is very good company to invest. After all, healthcare sector is growing. We have seen this COVID-19 impact, which is very huge and impacting very badly all over the world. So considering all of these events, the healthcare industry will be a very good from investment point of view. Thank you.